G'day guys, how are we?
Good, thanks, Cam.
Going well, thanks, Cam.
Excellent. Well, obviously we're here for our monthly economic and market update. It's been a bit happening in markets over the course of the last month, so I guess we're keen to take you guys through that and give you a further understanding about our views and what it is that we're thinking at the moment, what we're looking at. All right, so perhaps where we start is GDP growth. Again, as we discussed last time, guys, pretty looking okay, right?
Yeah, well, it's starting to stabilise at least, definitely.
Yeah, not a lot to report there. I think the trend will be interesting, and sort of the impact or the catch up from the interest rate cycle. What this looks like in the months ahead will still be probably a little bit early to tell. I think in the full trend of it.
Yeah, we're waiting for updated data on GDP growth. That's around the world. Then again in Australia, it's again still looking okay, but still looking for updated data that will come out at the end of this month, I think. In terms of wages and unemployment, so what we're looking at here is the wage price growth index, and perhaps what we've started to see is wage prices or salaries are actually starting to increase after just falling for years. This chart goes back to the early 2000s. It was falling. Now, obviously, we've seen a reversal of that. You guys want to talk through why we think that might be the case?
Yeah, I'll give you my view on that. I think it's obviously got record unemployment at this point in time, and with that brings a high degree of competition for staff, and I think that does push real wages up a little bit. But I think also too, I think we're now seeing the full impact of a lower immigration rate through the pandemic, and I think that certainly is contributing to less workers in the workforce, arguably, and subsequently wages having to be higher to actually attract people into businesses.
Yeah, it'd be interesting to see what numbers in those are actually also associated with, say, like government bringing out a 5% increase in EBAs. I suppose that was a few months ago, and whether those in professional services have started to negotiate their salaries up in relation, because everybody knows now inflation's going up, and the media's out there telling everyone that their real wages are going backwards compared to where they were a few years ago. Lots of people are changing jobs, asking for more money, so wonder how much that's obviously not broken down, but I would expect there'd be some element of that in there as well.
Yeah, I think we're a little bit in the silly season too. I think we sort of hear anecdotally of I'd say normal jobs being very enticing for people to change employees, be it sign-on bonuses and these sorts of things, which still for mine are quite outrageous, but it's happening. So it's certainly something which will influence these numbers without a doubt.
Yeah, it's just that the employment market's just getting tighter. It's getting tighter and tighter and tighter. And if you have a look at the participation rate, just continues that upward trend at the moment. What were the latest numbers this morning? 3.4% unemployment rate?
Not sure. I just was walking out of the office and Andrew said unemployment's down. It's like down again.
3.4. It's so low. I don't recall it being that low.
Well, 5's fully employed, right?
Well, this is why we're seeing this chart tick up, the participation rate. And that, of course, guys, is having an impact on CPI.
Look, certainly this data here, we haven't seen any reversal of CPI yet.
Not yet.
In Australia, and maybe jumping ahead a touch, but we saw some news on that last week in regard to the first snippet of inflation turning down in the US, but
that's that tiny little bit.
It's I think it's maybe indicative of the fact that interest rates are starting to bite, and I don't think we've seen the full impact of that here in Australia just yet. No. But I think we've followed the US heavily through most parts of this pandemic era, and I think that's maybe the first little indicative trend that we're maybe seeing things start to turn the other way.
Well, they started 2 or 3 months ahead of us, I think. Right. So, and last time we had this discussion, we were talking about the lag period for interest rate rises, and that it takes some time to actually show up in the data. I wonder whether this is the start of that. And to Shane's point about it not being fully realised yet, absolutely couldn't agree more with that. listening to a few things recently too about the synchronisation effect of interest rate rises. I think when we've been through big cycles in the past in terms of lifting of interest rates, we didn't have the level of globalisation that we currently do today, and so the correlation of rate falls recently over, say, the last decade or so, and then subsequently what we're experiencing now is the synchronisation of rates up. I'm not sure central banks have the data to assess, what is the impact of that correlation and synchronisation, whether that has a cumulative effect globally. So that's going to be interesting too.
Yes. So we also had equity markets jump on those
Yep.
on that really good news out of the US. A reduction in CPI. What was the? It was S&P was up 5.7 on the day.
Yeah, on the day. Nasdaq was 7.5 or so.
That's right, 7.5 on the day. That's
Yeah.
big numbers. So what does that speak to? Do you think?
Look, I think it speaks to, for mine, it's very indicative of this environment that we're living in, where we're directionless in a way, and the market is so jumpy on either side of good or bad news. And pleasingly for us as investors, last week we saw some good news from an equity market perspective, and but I think again the fact that it can go up 5% to 7% in a day is not normal kind of conditions. If that was a return in a year, that would be a pretty good year.
That's right.
Yep.
But a single day. So I think it sort of again highlights that fact of we're a bit directionless. The need to kind of allow our system to kind of work through this data that we're talking through today to stabilise a little bit.
Yep.
I think from my observation, it seems that's very important to not make decisions around portfolios when things are really so edgy when it comes to good and bad outcomes on market.
Absolutely.
Spot on.
I think it gives a bit of indicating flavour too on if this trend does continue, that there's going to be some big positive swings. I think until the talk starts to be, did we go too fast, and are we heading into a global recession? The sky's falling.
Yeah.
Let's see.
Yeah.
But yeah.
And again, I know we talk about this every time, but it's just so important. What we're talking about at the moment is what's happening month-to-month data,
Yep.
right, which impacts financial markets
Correct.
on a daily basis,
Yeah.
or day-to-day data. But it is so important to just stretch that time frame out, isn't it? So if you take the time frame out a year, 2 years, 3 years, 5 years, 7 years, 10 years, 20 years, they're just blips. You barely see them.
Yep.
Yeah.
Yeah.
And I think also too, to further to what we're experiencing today, the influence of the central banks right now
Yep.
is so notable from equity markets perspective, which
Yep.
kind of defies a little bit of the logic of investing, because some of the fundamentals are sort of ignored by this kind of unusual environment that we're living through, which again I think speaks to that theme you talk about there, Cam, about in time we'll look back and there'll be little blips in the charts, but living and breathing it right now is a reality what we're all working through.
Yeah, that's right.
The Fed speak or they move rates up or down, down not recently of course, but it does influence these outcomes, and CPI or inflation moving down last week probably slows that outlook down a little bit, and we are so accustomed to this need for low interest rates that the market responded positively.
Yeah, your point there about that. Like if you look back at the interest rate rise 2 months ago, where interest rates rose, Fed Chairman Powell said, we're thinking about maybe reducing the next rate to 0.5, and then markets were like, all right, we're done, it's over.
Yeah, that's
right. Markets went up, and then so this time, I think lesson learnt, came out and said, interest rates are going up, same quantum, but we are not done. Very tough language. Markets went the other way. So to your point, Shane, about the Fed's impact at the moment on financial markets, I agree, is completely disproportionate. But it's just interesting that it's completely decoupled from what's underlying fundamentals. It's really all about that. But who says investment markets are irrational and do what we think that they should? It's funny.
Okay, and then I suppose this just speaks to Australian interest rates. So this is the cash rate target, and again, we've pulled this back all the way to the early 90s actually, and we would recall recall back then when interest rates, home loan interest rates were around about 9, term deposit rates are about 7. Gee, that sounds, it's a different time, isn't it?
Exactly.
And we've spent this period of time through here really from the start of the GFC, where interest rates have just been dropping and dropping and dropping and dropping, and it got to a point, as we all know, where they almost hit zero. That's clearly turned around. So the RBA has been hiking interest rates, as we've been talking about, and then that is having an impact on both financial markets, the economy. It's having an impact on bond yields and having an impact on equities. I guess the other thing to talk through here is consumer sentiment. This was the ANZ Roy Morgan survey that they do, and you can see since we've seen this hiking in interest rates, consumer sentiment is starting to dive. Okay, which also again speaks to, this is only one survey, but it does speak to the fact that as consumer sentiment falls, people are spending less, right? So we're starting to hoard more, which is what the point of the increasing in interest rates is all about.
Yep.
Yeah, and I think also too, I think some of the language from the Reserve Bank here in Australia has been clever insofar as almost trying to paint a very unpleasant picture to try and have this consumer sentiment dialed down, because they're obviously acutely aware that the instrument they've got to use is the interest rate tool that we saw on the previous slide. But if that happens concurrently with consumers spending less in the short term, then perhaps the ferocity of that rate rise starts to slow down a little bit. So, my observation here, this consumer sentiment is twofold, in that interest rates do force people to feel a little bit uneasy. But secondly, the language that we've seen from the Reserve Bank, our government, and the media more broadly, kind of spikes that sort of fear, if you will. And it's interesting to see, right there in that quite a dramatic drop off, back to kind of pandemic levels, really.
That's right, exactly. Next slide, around Australian house prices, household debt, net wealth. You guys want to talk through some of this?
Yeah, well, you can see that we're starting to, at least the gradient of those, at least on the housing prices side, we're starting to see the drop off, and I'm sure, everyone's reading all the media articles about how much capital cities and the average house prices are coming off, and, that probably ties into some of the slides we're looking at. One, consumer sentiment, interest rates are going up, which means banks are lending less. I think we've walked through the link between people's ability to borrow and house prices in the past. That kind of makes sense, but, household debt's starting to flatten out a little bit, which is probably a good thing too, given things were probably getting a little stretched there.
Well, I suppose if you have a look at housing loan commitments here, so we have seen a fall in both owner-occupiers and investment lending. So again, the cost of buying a home is now more expensive, right? Because interest rates are higher.
Correct.
So price then dictates that demand is less, forcing house prices down, because that's essentially how people buy homes, is they use a bank to do it.
It's interesting in a lot of these, like we're seeing house prices fall, housing loan commitments fall, sentiments down, net wealth, if I look at that top right chart, net wealth is down. If you were just to look at those in isolation, that would paint a fairly gloomy picture of, where things are at. You could look at that and go, let's extrapolate that down.
Yes.
It's all looking pretty terrible. I don't know whether it's the way I look at things, but I guess given what we've been through, I look at that and think, okay, well, this is a reasonably good thing. And most of this data mean reverts. So if you go back to, say, consumer sentiment, I think it was Shane that you said, we're back at pandemic levels in terms of the negativity. So I would look at that chart and say, well, yes, consumer sentiment's terrible at the moment. But if you look back at what the mean has been over, that decade or so, you'd expect at some point in the, wouldn't say near future, but at some point in the future, that sentiment comes back up, and what drives that sentiment is, People are feeling they're wealthier. People feel like they're secure in their jobs. People feel like they've got money to spend.
Yep.
All those sorts of things.
Exactly.
So there's if you, in terms of the psychology of it, looking at it, you can kind of look at it two ways. Whether you're taking it in its own silo or in its greater context, I think it's important to look at that. Although we're talking about those things being down, it's down in probably a positive way, I would view.
Yeah, I think that point you say there, Chris, about greater context is so crucial, because that the chart on the following page there, Cam, the net wealth, or up the top right hand corner there, and or even the top left with housing prices and that spike at the top there. When we look at kind of the very short term movement, it's a unpleasant read, and the headline grabbing is always sensationalised.
Yep.
But to your point about mean reversion, the long term trend of those asset prices is still quite okay.
That's great.
And it's a bit of a spike there, and we'd all agree that when you see a spike of that kind in the top left there, that I see that, I worry immediately, because I think that's really unsustainable to have that as a consistent trend.
Yep.
So, when you take a breath and pause for a brief moment, when you see those things, you think, well, longer term, perhaps it's a good thing to kind of have sustainability over time. But yes, in the short term, it's never a pleasant, experience to live through, really.
Definitely. And it also speaks to what the Reserve Bank's also trying to do, right?
Yeah, it's by design. Yeah.
Correct. Yeah. We're trying to create long-term stability where we don't have big wild swings. Trying to squeeze the chart. It's just we've come from COVID and what happened, and we needed a period to kind of bring us back to in line with where we would want to be from a stability standpoint.
Yeah, spot on. All right, in terms of financial markets, what we're looking at here is bond markets, and just typical examples of what bond markets have done over the course of the last 12 months. It's fair to say, with rising interest rates, that bonds have been hit pretty hard.
Yep.
And in terms of global bond markets, down 14.6%. In terms of the Australian bond market, down somewhere between 9 and 11, depending whether it's corporate bonds or government bonds. And we haven't, as we talked about last time, we haven't seen those sorts of numbers out of bond markets. It was 3 times in 100 years, I think we've seen both equities and bonds falling at the same time.
Correct.
So it's extremely uncommon. Importantly there, though, the 1 month numbers, and this is, I think, off the back of the fact that the market is perhaps realising, or the potential is that it's realising that we're getting closer to the end of peak rates, so end of the tightening cycle.
Yep.
The bond markets have responded somewhat favourably, I suppose, haven't they?
Yeah, and I think this is still to all the discussion point around volatility and the like. For mine, these two charts here are still probably the most telling from an investor's point of view.
Yeah,
because as we've talked about previously, the diversification principles have failed us in this cycle. To your point there, Ken, 3 times in 100 years where we've had negative bond and equities, we haven't been given any shelter from assets such as bonds, which we would normally rely upon, which is made it hard. But pleasingly, it's always nice to kind of see some kind of reversal of that negative trend, because it does reward those that are patient with their asset allocation, their portfolios.
Similar sort of trend in equities, guys. So the S&P 500, which is the US equity market, down 15 over the last 12 months. The NASDAQ down 29. Europe down 11. Interestingly, Australia down 4. That's more a measure of timing than anything else, I think. So we've seen significant negative returns out of equities. But again, over the last month or so, we've seen that start to revert. So some more significant numbers on the way back up there.
Yeah, and I think it speaks to, as we were talking before, it speaks to this kind of reliance the world's got on, almost what I term as the drug of interest rates. It's certainly it's like we need it pumping through our veins to see the financial system operate as we know it. But really, I think what we're experiencing is a recalibration of the way in which assets are priced, and pleasingly, to your point there, Cam, when the market takes a breath and realises, perhaps we've gone through this cycle, we're there and it's manageable, it's going to be okay, that we start to see assets, sort of trend back up in a more positive way, a more way which reflects, what are still pretty good underlying earnings in businesses.
Yeah, correct. as he talks about before, like you start to get that reconnection back into the underlying fundamentals because
earnings growth has actually been quite strong, both in the States and in Australia over the last 12 months.
Yep.
Well, as we talked about in the budget update a couple of weeks back, our government's not forecasting recession in Australia.
No.
And that number which we showed before about Aussie market not being as bad as the US, it speaks a little bit to that.
Yeah.
But again, you'd sort of have intuitively you feel as though we're in really tough economic conditions because the media is always talking about it. We're hearing bad news consistently.
Yep.
Share markets, bond markets down. So that kind of negativity and the consumer confidence levels being down. But again, when we hear the hard data from Treasury, they're forecasting, we're going to muddle our way through this economically. Not prosperous, but muddle, I think, is a...
1.5 it was.
Yeah.
GDP growth.
Doesn't sell advertising revenue or clicks, Shane. That's very boring of you.
Indeed.
How cynical of you.
Yes.
Okie doke. And I suppose one to finish off on is, we talk about this regularly. What we've just chatted about is short-term volatility. What matters is what happens over the longer term. And this slide speaks to that. So, that was the major one here was the bull market from 86 to the GFC, which was 1,200%. Then we had the GFC where for one and a quarter years, something like that, we got a minus 48, minus 50, which is big, right? That's a big deal. But in context of how much equity markets have grown over the longer term, it pales in comparison, right?
Yeah.
Yeah,
and I love this chart for the very reason of time and context, but it certainly still speaks to the empathy and emotional component that is very difficult in times of difficulty like we're experiencing today. But so I always look at this chart as a bit of a reminder of thinking, okay, yes, the longer term strategy does work, but trying to take ourselves out of that emotion of what is a really notably difficult environment that we've been through this year. I think this is a good reminder that we can lift ourselves above it and hope that that in time that these trends continue to go as they have always done.
As they should do. Chris, you got anything you want to add?
No, I don't think so. No.
All right. Well, I think that rounds us out, guys, for another monthly edition of the Economic and Investment Update. We look forward to getting your feedback if you made your way all the way through to the end. So thanks again.
Thank you, everyone.
We'll see you next month.
Bye for now.
Bye.